Most retirees are silently losing over $100,000 in taxes they never had to pay, simply because they withdraw from their retirement accounts in the wrong order. I want you to sit with that for a second. $100,000, maybe $200,000, sometimes more, gone to the IRS over a 25-year retirement, all because nobody ever sat them down and explained how withdrawal sequencing actually works. Today, we're fixing that. By the end of this video, you'll understand the tax-efficient withdrawal strategy that wealthy retirees and their financial advisors have used for decades to minimize lifetime taxes. And I'm going to show you how to execute it yourself, without paying an advisor $3,000 for the privilege. Let's start with why the typical approach fails. The conventional approach most retirees follow isn't stupid. It's actually logical. You have retirement savings in a retirement account. You need retirement income. You pull from the retirement account. It's the obvious move, and for decades it worked fine, because tax brackets, Social Security taxation thresholds, and Medicare premium surcharges weren't nearly as punishing as they are in 2026. What changed is the tax environment around the withdrawal, not the withdrawal itself, and that single change is what turns the obvious approach into a six-figure mistake. Here's why. Every dollar you withdraw from a traditional 401k or IRA is taxed as ordinary income. In 2026, that means your Social Security benefits become taxable once your combined income exceeds $25,000 single or $32,000 joint. Your Medicare premiums trigger IRMA surcharges at $109,000 single or $218,000 joint. Your capital gains tax rate jumps from 0 to 15% once your ordinary income passes certain thresholds. By draining your traditional retirement accounts first, you're pushing your taxable income up every year, triggering higher tax brackets, Medicare surcharges, and Social Security taxation simultaneously. This compound effect is what retirement planners call the tax torpedo, and it can easily cost you $300,000 to $400,000 over a 30-year retirement. Now let's talk about the strategy that works. The tax-efficient withdrawal sequence divides your retirement income into 3 phases over a 25 to 30-year retirement. Phase 1. Your 60s. This is the critical planning window most people waste. In your 60s, particularly between retirement and claiming Social Security, your taxable income is often at its lowest point in your adult life. You're not earning a salary anymore. You haven't started Social Security yet. Required minimum distributions don't start until 73. Your tax bracket might be 12% or even 0. This is the single most valuable time of your life to execute Roth conversions. A Roth conversion moves money from a traditional IRA to a Roth IRA. You pay income tax on the converted amount today, but then that money grows tax-free for the rest of your life and isn't subject to required minimum distributions. Here's the math. A 62-year-old with $600,000 in a traditional IRA doing strategic Roth conversions of roughly $50,000 per year for 5 years pays between $6,000 and $11,000 in federal tax annually, staying in the 12% bracket. Total conversion tax, roughly $45,000. The alternative? Don't convert. Let that $600,000 grow to roughly $900,000 by age 73. Required minimum distributions start pulling approximately $35,000 per year out of the account, forcing it into ordinary income and potentially pushing the retiree into the 22 or 24% bracket. Over 20 years, that forced withdrawal pattern costs approximately $180,000 in federal tax, 4 times the cost of strategic conversions. The 2026 tax environment makes this even more valuable. The One Big Beautiful Bill Act created a temporary $6,000 deduction per person for anyone 65 or older through tax year 2028. For a married couple where both qualify, that's $12,000 off taxable income. Layered on top of Roth conversions in the 12% bracket, the effective tax cost on conversion drops dramatically. Phase 2. Your 70s and required minimum distributions. Once you hit 73, the IRS requires you to start withdrawing a specific percentage from traditional retirement accounts every year based on life expectancy tables. Your first-year withdrawal is roughly 3.8% of your balance. The percentage climbs every year. By age 80, it's approximately 4.9%, and by 90, it's over 12%. If you did your Phase 1 planning correctly, your required distributions are much smaller than they would have been, because you already moved a chunk of your traditional IRA to Roth, which has no required distributions. Here's the critical order during Phase 2. First, take your required minimum distribution. You don't have a choice. Second, if you need additional income beyond the required amount, pull from taxable brokerage accounts, where you only pay capital gains rates on appreciation, not ordinary income rates on the entire withdrawal. Third, only after taxable accounts are exhausted, withdraw additional funds from Roth accounts, tax-free. Never pull from Roth until you've drained taxable accounts. Roth is your most valuable asset because its tax advantage compounds the longest. Phase 3. Your 80s and beyond. By this stage, ideally, your traditional retirement accounts are smaller because of Phase 1 conversions. Your taxable brokerage accounts may be largely depleted. Your primary income is Social Security, plus whatever remains. Roth accounts at this point become your buffer. Unexpected medical costs, long-term care needs, helping family. Every Roth withdrawal is tax-free and doesn't count toward combined income for Social Security taxation or IRMAA thresholds. This is why Roth money is so valuable late in retirement. Now, let me cover the scenarios where the rules flip. Scenario 1. You have large unrealized capital gains in a taxable account. If you have significantly appreciated stocks in a taxable brokerage account that you want to leave to heirs, the step-up in basis at death eliminates the capital gains tax for them. In this scenario, you might actually prefer to withdraw from retirement accounts first and preserve the taxable brokerage for inheritance purposes. Scenario 2. You expect to be in a higher tax bracket later. If you anticipate substantial income later in retirement, from a part-time business, rental properties, or inherited IRA distributions, you might front-load traditional account withdrawals in your 60s to lock in lower current rates. Scenario 3. You're planning to move to a no-income tax state. If you're currently in a high-tax state, but planning to relocate to Florida, Texas, Tennessee, or another no-tax state, you might delay Roth conversions until after the move to save state income tax. Let me finish with the biggest mistakes retirees make with their withdrawal strategy. Mistake 1. Not starting the plan until the required minimum distributions hit. By then, you've lost 10 years of strategic opportunity. Start planning at 60. Mistake 2. Doing Roth conversions too aggressively and pushing into higher brackets. The goal is to convert just enough to fill the bracket you're currently in, not so much that you trigger 22 or 24% rates. Modeling matters. Mistake 3. Forgetting about state taxes. Some states tax Roth conversions fully. Some don't. Know your state's rules. Mistake 4. Ignoring IRMAA. A Roth conversion that pushes your income above $109,000 single or $218,000 joint triggers Medicare premium surcharges. For some retirees, the IRMAA surcharge outweighs the conversion benefit. Mistake 5. Not coordinating with your Social Security claiming decision. The lower income years between retirement and claiming are your prime conversion window. Waste them, and you've wasted the strategy. So here's your action plan. First, list all your accounts and balances. Traditional IRAs, 401ks, Roth IRAs, taxable brokerage accounts, savings. Second, estimate your annual expenses and your tax bracket in retirement. Third, identify your conversion window. The years between retirement and either Social Security claiming or required minimum distributions, when your taxable income will be lowest. Fourth, calculate how much you can convert annually while staying in the 12% bracket, typically somewhere between $30,000 and $60,000, depending on other income. Fifth, execute conversions each year. Repeat for 5 to 10 years. The longer your runway, the larger the savings. This is not theoretical. This is not reserved for wealthy retirees. This is basic retirement tax planning that any disciplined person can execute. The difference between doing it and not doing it can easily exceed $100,000 in lifetime taxes. In our next video, we're answering the question everyone asks. Still, nobody can agree on, how much money do you actually need to retire? The real answer, in 2026 dollars. Subscribe now so you don't miss that. And drop a comment telling us which phase of retirement you're in. We'll tailor future content to where most of our viewers actually are. We'll see you in the next one.